Hello friends. If you were born before 1959, there is a very good chance that at least one Centrelink rule in 2026 applies directly to you right now. And here's the problem. Most age pension mistakes don't happen because people break the rules. They happen because people assume Centrelink already knows everything. They assume their records are correct. They assume a small change won't matter. They assume if there is a problem, someone from Services Australia will contact them before money is affected. Unfortunately, that isn't always how the system works. In fact, throughout 2026, thousands of Australian retirees are discovering their pension rate changed, their concession eligibility changed, or their reporting obligations changed because of something they didn't realise had to be updated. So here's the direct answer to today's warning. If you were born before 1959, the biggest risks right now involve unreported asset changes, outdated income information, partner circumstances, superannuation movements, and entitlement reviews that can affect your age pension rate or concession benefits. The good news, most of these problems can be fixed before they become expensive. That's exactly what we're covering today. We'll go through each age group, explain what matters most in 2026, and show you the specific things worth checking before your next Centrelink review. But before we begin, if you haven't subscribed yet, make sure you do that now and turn on notifications.
The reason is simple. Age pension rules are not static. Payment rates change, asset thresholds change, income test rules change, reporting requirements change. And Centrelink doesn't send every retiree a personalised explanation every time something is updated. This channel exists to break down those changes into plain English so you know what they actually mean for your retirement income. Now, let's get into it. Section 1. Born between 1943 and 1950. If you're in this group, you're now in your late 70s or 80s. Many people in this age range believe their pension situation is already settled. After all, they've been receiving payments for years. But this is actually one of the groups most likely to overlook important entitlement checks. The first issue involves relationship changes. Widows and widowers are one of the most commonly affected groups when pension circumstances change. Many people update some records after losing a spouse, but don't realise that other benefits, concessions, or pension calculations may also need review. We've seen situations where someone continued receiving payments based on outdated information simply because they assumed everything transferred automatically. If you've experienced a major life event during the last few years, it may be worth checking whether all records held by Centrelink are current and accurate. The second issue involves concession cards. A surprising number of retirees continue paying higher costs for medicines, medical appointments, utilities, and local council charges simply because they never reviewed what concessions they're entitled to receive. For some households, those savings can amount to hundreds or even thousands of dollars across a year. And in a period where living costs remain elevated, that's money worth checking. Most retirees focus entirely on their fortnightly pension payment. Many forget the value of everything attached to it. That's where hidden losses often occur.
Section 2. Born between 1951 and 1954. Now we move into one of the most important groups watching this video. If you were born in this period, you're already at or beyond age pension age, and many of you are receiving either a full pension or a part pension. The biggest issue affecting this group in 2026 is assets. Not because the rules changed dramatically, but because many people underestimate what Centrelink actually counts. Let's talk numbers. Under the March 2026 Age Pension Assets Test, a single homeowner can generally hold up to $321,500 in assessable assets before their pension begins reducing. For homeowner couples, the full pension threshold is $481,500 combined. Beyond those levels, payments gradually reduce under the assets test. Here's where people get caught. They focus on bank accounts, but Centrelink may also assess shares, managed funds, investment properties, caravans, boats, vehicles above normal household needs, and other financial assets. Many retirees haven't reviewed those figures for years. Then one day they sell an asset, receive an inheritance, move money between accounts, or make a large superannuation withdrawal. Suddenly their assessable position changes, and if that change isn't reported correctly, problems can follow. The lesson here isn't fear, it's awareness. The more accurate your records are, the lower your risk of unpleasant surprises later.
Section 3. Born between 1955 and 1958. If today's title applies directly to you, this may be the most important section of the entire video. This group sits right on the edge of several key retirement decisions. Some are already receiving age pension. Others are transitioning from work. Others are drawing income from superannuation while evaluating when and how to claim government support. The mistake we repeatedly see involves assuming superannuation decisions and Centrelink decisions are completely separate. They're not. The interaction between super balances, account-based pensions, investment earnings, deeming rules, and age pension assessments is where many retirees become confused, and confusion can become expensive. Here's something many Australians don't realise. Centrelink does not simply ask how much income you physically withdrew. Different financial products can be assessed differently under the means testing system. That's why two retirees with similar balances can sometimes receive different outcomes. The key point for this group is straightforward. If your financial circumstances changed in the last 12 months, don't assume your previous Centrelink assessment still reflects reality. Review it, check it, confirm it. Because once incorrect information remains on file for long enough, resolving the issue becomes far more complicated.
Section 4. The 2026 Asset Threshold Trap. Now let's discuss the warning that has been catching attention across retirement forums this year. The part pension zone. Many Australians incorrectly believe that once their assets exceed the full pension threshold, their age pension disappears. That's not how it works. In many cases, retirees continue receiving a part pension long after they lose access to the maximum rate. For example, under March 2026 rules, a single homeowner may continue qualifying for a part pension until assessable assets approach roughly $722,000, while homeowner couples can remain eligible until around $1.085 million in combined assessable assets. Why does this matter? Because thousands of Australians assume they're no longer eligible and never investigate further. Others receive a small pension and don't realise that pension access can unlock additional concessions and benefits beyond the payment itself. That includes healthcare-related concessions, pharmaceutical savings, and other state-based support programs depending on where you live. A small pension can sometimes provide access to much larger savings. That's why eligibility reviews matter. Section 5. The reporting mistake families keep making. Now let's talk about something family members need to hear. Adult children often help parents manage finances, and while that help is usually well-intentioned, it sometimes creates reporting problems. Selling a property, moving funds, changing ownership structures, adding a family member to an account, gifting money. These decisions could all have Centrelink consequences. The problem is that many families speak to accountants, lawyers, or banks but never consider how the change affects age pension assessments. Then months later they receive an unexpected letter. This is exactly why communication matters. If you're helping parents with financial decisions, make sure Centrelink implications are considered before changes occur, not afterwards. A 10-minute conversation today can prevent months of frustration later. Final summary. So let's quickly recap. If you were born between 1943 and 1954, review concession entitlements and ensure all major life event records remain accurate. If you were born between 1951 and 1954, pay close attention to assets and how they're being assessed. If you were born between 1955 and 1958, review any recent superannuation, investment, or retirement income changes and make sure Centrelink records still reflect your actual situation. And for everyone born before 1959, remember this. The biggest age pension mistakes rarely come from doing something wrong. They usually come from assuming nothing has changed.
In 2026, a simple review of your assets, income information, superannuation arrangements, and reporting obligations could help you avoid payment disruptions, overpayments, concession losses, or entitlement mistakes that many retirees never see coming. If you found this useful, subscribe to the channel. And most importantly, share this video with a parent, sibling, neighbour, or friend who receives the age pension. Because the people who hear about these issues early have options. The people who find out after the review letter arrives often wish they'd checked sooner. Thanks for watching, and I'll see you in the next update.